Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most and do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
Okay, welcome to The Wealth Flow. My guest today is Tucker Thompson. Tucker is the founding partner at Sweet Bay Capital, which invests in multifamily assets in Virginia and the Carolinas. Tucker has a long track record of investing in both real estate as well as companies. Tucker began his career at JPMorgan, focusing on mergers and acquisitions before joining Griffin Investors as a member of its investment team. Across these roles, Tucker worked on LBOs, IPOs, and mergers and acquisitions. Tucker began investing in real estate as a side project before launching Sweet Bay. So, Tucker, welcome to The Wealth Flow.
Thanks, Keith. Really happy to be here.
Yeah, happy to have you. And I usually will start, Tucker, with just everybody's background. Where did you grow up? You had some very interesting careers, even before getting into to real estate. So I'd like to hear a little bit about that as well.
Sure. So I was born and raised in Richmond, Virginia, and also went to college in Virginia as well before moving up to New York City to start my career in investment banking, as you mentioned, at JPMorgan. That wasn't actually real estate focused at all, but was kind of the first step in the process of building the toolkit that I would later use in real estate investing, being able to get a really firm grasp on financial analysis and modeling and working on deals and dealing with lenders and seeing the legal aspect of things through kind of the advisory work we were doing on a lot of different types of transactions in investment banking. Did that for a few years and then made my way out to San Francisco, California to work at a private equity fund where I was working on the investment team, focusing on actually mostly transportation, logistics companies, as well as some software companies as well. That's where I met my business partner in 2018, Max Sheldon, who later founded Sweet Bay with me. Again, that also wasn't even real estate focused, but at that time, we started investing in real estate on the side just as a way to generate passive income for ourselves. So while we had our day jobs out in San Francisco, we started buying rental houses in South Carolina. Mac had started a little bit before me and kind of pulled me along to start doing it with him. And then after a couple of years, we had 5 rental houses between the two of us that we all owned personally. Those are actually student rental houses in Columbia, South Carolina for college students.
Oh, cool.
And they generated really strong cash flow. And, over the couple of years that we were working together in private equity, we learned a lot more about the investing side of things and raising money and raising debt and everything you kind of need to put together a transaction. In the meantime, we were kind of self-educating ourselves on the real estate side of things. And so at one point, we just decided to try to team up and kind of combine those two skill sets that we had developed in our careers to see if we could do something bigger in real estate, which led to our first syndication at Sweet Bay in 2021. which was for a portfolio of those same student rental houses that we had been buying. So it was a really natural, easy step for us to go from buying for ourselves. We are very familiar with the market and the product that we were buying, to making the next step and bringing in a group of investors to buy a larger portfolio of those houses. So that's the quick overview of my background, and also a little bit about how Sweet Bay got started. And then once we closed that transaction, we kind of it took off from there.
That's pretty neat. And so so you guys started with just housing. Tell me a little bit about that. Maybe, I know just from my own college experience, when we've rented a house, there's different ways you can set it up. Obviously, you can set it up as a traditional rental, but you can also do it where you're renting just basically a room in the house. How did you structure those to kind of maximize the cash flow?
Yeah, so that you bring up a really good point. With student rentals, the advantage of that is that you're effectively renting to 5 different people, and so, or 3 or 5 different people. The houses we were buying were mostly 5-bedroom cottages, all in this purpose-built student housing development that had a pool and a clubhouse and things like that. It was part of a broader HOA, and we would just buy individual houses in that development. But to your question, we leased them out, each bedroom as its own lease. And so, as opposed to renting like a single family house to a single family with really one source of income, you're renting each bedroom to a different person, and therefore can get a bit of a premium on the rents, as you otherwise would if you were just renting to, a husband-wife couple or something like that. So they do generate really strong cash flow in that way. The trick is just that you have to really match up your leases with the school year. And every 12 months, in most cases, your students you might have some that stick around for a second year, but a lot of them are graduating or moving on to other houses or other things like that. So you really have to be prepared to deal with a lot of turnover. And if you go into the school year with a handful of vacant units, for example, then it can be really hard to find students that need housing in December, because they've already been on school and campus for a couple of months and would have already figured that out. Right. So it puts pressure on the leasing and the turnover. But if you can do a good job of that and go into the school year fully occupied, then the cash flow is typically really strong, because you have, like I said, those 3 to 5 different leases in a house, and parents guaranteeing all of those leases. So the credit strength of the tenant base is actually quite strong.
Yeah, that makes total sense. I had to do that with my daughter, and was the one that actually signed the guarantor on the lease, which makes sense. And certainly, it's especially when you're renting, I guess, to students, that you'd want something like that. You bring up a good point. I didn't really think about it from the standpoint of, the timing. But you're right. I mean, you're not going to have somebody that, starts somewhere. Typically, if they're going to start, they're either committing to a dorm, they're committing to something for a set period of time. And so, I could see how that turnover would be.
I mean, the way it works, at least at the University of South Carolina, is I think freshmen and sophomores, first and second year students, typically live on campus for the first 2 years, and then third and fourth year, a lot of them move off campus. And typically in September, October, November of your sophomore year, you are already looking for housing the following year. And so most of our bedrooms were leased up in December, 9 months before the next batch of students would come in. So if you do it right, you should have a lot of visibility and comfort that, you're going to be fully occupied the next year. So it worked out really well for us. That transaction we closed was for a portfolio of 11 of those houses. It was small, but it was the first one we did, and it was while we still had our full-time jobs. But it went really, really well, and we sold that portfolio in January of 2023, about 15 or 16 months after we purchased it, for close to a 2x return. So nice. We were able to make a really great, quick win and have that exit kind of on our track record early on, which is really helpful as we actually later officially launched Sweet Bay as our full-time jobs.
Yeah. And how did you find the 11 existing units or portfolio? Was that something that somebody approached you because they knew you guys owned some in the same HOA, or what? How did that come about?
So we had just developed a really strong relationship with the broker in Columbia that was selling most of these houses. As I said earlier, we had bought 5 of them from him, and over the course of that time, he, I think, realized that we were easy to work with, closed on time, didn't back out of transactions. We never signed a purchase agreement and then later backed away from him. And so when he got this portfolio, we were the first person that he came to, and the owners of the portfolio weren't really interested in doing an auction. They just wanted to get out. And so we were able to kind of step in quickly and put a deal together. So it took a long way. Like, we wouldn't have just been able to find that if we had just been starting out and hadn't built this rapport with the broker. So kind of planting those seeds and nurturing them and making sure that you maintain your relationships with kind of those gatekeepers can be really important. And we wouldn't have been here today if we didn't do that. So it's really important.
Yeah, for sure. I think it just kind of goes to the fact that building the relationships is good, and it's amazing still agency today. Sometimes people through a transaction just act as if that's going to be their only purchase. And really should be a win-win. And you want to be able to do business with these people in the future and treat them accordingly. So that's awesome. So what did you do from there, Tucker? So you got the 11 units. You added those to your 5. Did you sell the 5 existing units along with the 11 for a total of like 16?
No. We always kept those separate. Okay. I sold the ones that I owned over the last couple of years, and I think my business partner Max still actually owns one.
Okay.
We so through the life of that investment, we actually ended up getting the portfolio to 13 units. So we would basically sell one and trade it out for a bigger one, which is one of the ways we generated the value. And then in January 2023, we sold them all, and then everyone 1031 their money into our second acquisition, which were 2 multifamily apartment buildings totaling 41 units. That was our first real multifamily acquisition, which was a little bit over a year ago.
Okay. And those 2, are they kind of in the same general area, or are they, from a geographic standpoint, where are we looking on these?
We bought them as a group in Roanoke, Virginia. They're a 5-10 minute drive from each other.
Okay.
And that was at that point in February 2023 when that transaction closed. We had our first exit from the Columbia portfolio, and we had our second acquisition completed in February. And that was kind of the inflection point for officially launching Sweet Bay as a business and leaving our full-time jobs to pursue it full-time. We felt like it was a good inflection point. And frankly, the amount of time we were spending on the real estate side of things was getting to compete a lot with our day jobs, and it was just becoming hard to manage both.
Sure.
So it ended up being a really good natural transition point. The timing just worked out really well.
What were maybe some of the differences, if any, there may not have been, but between kind of these individual houses that were in this HOA and how you manage that versus these, or jumping from essentially 16 units to 45 units? What were some of the differences that you saw there, if any?
Sure. Well, if you depending on how you look at it, because all the units, all the bedrooms in the first transaction were individual leases, you could almost look at it as 40-ish units.
Yeah. That's true.
So again, it is a much different game because with the second acquisition, we were actually doing renovations and things like that and being much more hands-on with the property and improving them. The previous transaction in Colombia was much more of a stabilized cash flow play where we thought they were just significantly underpriced, and that's kind of how it played out. But the second acquisition was much more of a traditional value add investment where the previous owner had owned them since the late 80s or 90s and hadn't spent a lot of money on the properties and was just focused on occupancy because his basis was so low. And we were able to kind of take over, put in a new management team, invest a lot into the property, fixing up all the deferred maintenance, improving the exteriors and the curb appeal, actually marketing the apartments online. You'd be surprised how much of an impact that makes if the previous owner was, like as I said, focused on occupancy. And we've been able to really grow NOI a lot over the last, 12, 13 months of those properties. Our trailing NOI today is actually where we underwrote it to be at exit in 5 years. So we're very far ahead of our business plan. And we've also been able to do that by spending less than what we budgeted on CapEx too. We really took a conservative approach to the amount of money we need to spend on renovations, and we've been coming consistently under budget the entire time. So it's been a really good start.
Yeah, that's great. It's always great when that happens versus the opposite. What are some of the improvements that you're making on the property? You mentioned some remodeling, but what are some of the other levers that you're pulling to try to increase that NOI?
Sure. So just starting from the outside in, updating the signage, repainting the property, making some improvements in landscaping. And then, as I also mentioned, taking professional photography and getting ads up online on apartments.com and places like that. Having a more active presence with the property manager. The previous owner was using a management company that, doesn't have dedicated payroll and things like that. So, sometimes in those situations, the properties don't get as much attention with, servicing maintenance requests quickly and stuff like that. So providing better service to the tenants. And then as people's leases expire and people decide to move out or whatever, then we go in and renovate the units up to kind of a more modern standard, new appliances, new flooring, paint, those kind of typical sorts of cosmetic improvements to make the units just have a more modern finish and up to standard with some of the other competing properties around. And, with that also increasing the rents.
Yeah. And does that one have on-site management, or is it like a third party that, I guess not everybody's good, but do you have somebody on staff there?
We hired a management company, and then we had a part-time manager who would use the office at another larger property nearby that the property management company also managed.
Okay.
And since then, we've bought another 90-unit property in Roanoke that did have its own office. And so now we have bumped that part-time person to full-time and moved him into the on-site office at the 90-unit property. And so now he manages all 130 of our units from that one larger property.
Okay. And they're fairly close to each other?
They're fairly close to each other, and the two that we bought a year ago are now mostly stabilized and kind of run themselves for the most part. When people move out, he'll have to go over there for, a tour or two or whatever. But they are very clean, kind of quiet properties that don't need a lot of hands-on attention. And so most of his time now is spent on the 90-unit property, which we're only 3 months into now, so very much still in the kind of work phase as opposed to the stabilization phase.
And so you went from a 45, you doubled again on unit count to now 90. Any differences there? Anything when you've jumped? I know it's fairly new, acquisition at this point, but any changes or anything different? Obviously, one change with the full-time property manager instead of part-time, but anything else that you kind of have noticed?
the third property or the third acquisition that we did, the most recent one, the 90 units, is definitely kind of a step up in terms of just the amount of things that we need to manage. I mentioned making the property manager go from part-time to full-time, but now we also have a full-time maintenance supervisor as well to kind of help oversee things too. And there's just a lot more units to turn and renovate. And so with that, there just is naturally more unexpected issues that come up or other distractions and things like that. So it's just been, everything has gone as we'd expected. It's just, there's just that much more things to think about and take care of, or other little random issues that come up because we're just doing more volume.
Yeah, makes sense. And then so you've got a full-time maintenance guy now. Are you being able to utilize the full-time maintenance guy for all of your units? So not just the 90?
The payroll spread across all 130 units. So it makes it a lot more efficient than just having it at the 90.
Yeah, for sure. And with that one, how did you find that? Was that through brokers as well? Yeah.
Yeah, good. We can circle back around to the question on the first deal. This broker was also someone that we've kind of been cultivating a relationship with too. He was the one that we bought the first two properties in Roanoke from a year ago. And after we closed that with them, we've kind of kept in dialogue. And we actually sent him a list of properties in Roanoke that we wanted him to call on for us. We highlighted probably 8 to 10 that we were really interested in, kind of the right size range, right vintage. Didn't seem like they had been fully maximized yet in terms of having really hands-on management that's been invested in the properties. And we sent him that list, and literally a couple days later, the owner of one of the properties on the list called him and said, "Hey, I'm thinking about selling." And he just was able to say, "Well, that's good timing because someone just reached out to me the other day and was interested." So he put us in touch with them, and we were able to do a quick kind of off-market transaction. So it just really worked out serendipitously. I didn't really expect the conversion rate on that list of properties with him to be that high, but it just got lucky. And of course, having that relationship with him, he was willing to he volunteered to kind of do that for us. And it just ended up working out really well. And again, it goes back to just focusing on relationships with people like that.
For sure. No, that's fantastic. Great timing. It's amazing how things like that will happen. I mean, you just gave him the list, and the guy happened to be reaching out as well. That's awesome. What about some of your previous job experience? Do you think some of that sort of translated well to your current role? And if so, how?
So I think the obvious areas of overlap are the modeling, the financial analysis, the underwriting, knowing how to speak to lenders, knowing how to speak to lawyers, knowing how to negotiate on terms and things like that, being able to put together an offering memorandum. All of that is very similar. The learning curve is kind of getting out of the spreadsheet and out of PowerPoint and out of Microsoft Outlook or wherever, and actually doing the physical work at being on site at the properties and executing the business plan. That's kind of where the real learning is, and also where the real value is added. And that's something that we've been able to teach ourselves as we've kind of progressed into real estate. As I said, first starting out with our personal investments into just one or two houses at a time, to doing a portfolio, to doing a real multifamily acquisition of 40 units, to taking the next step to 90. And I think we've been successful in doing that because we've had the other kind of skill sets filled out so strongly that we've been able to, I guess, kind of navigate things well, and making sure that we're underwriting thoroughly and with lots of conservatism. So in case those random things happen that we didn't budget for, that always happen, we're prepared for that. And it doesn't come as a shock, and doesn't cause us to go off budget or anything like that.
Yeah. And what about the capital raise piece of it? On the initial one, how much did you have to raise, and were these prior relationships that you had, or how did you establish that side of the business?
Sure. So the first deal, the first raise was admittedly pretty small, but at the same time, we didn't have any formal experience in real estate, and we had no idea what the reaction was going to be from the people that we sent our offering memorandum to. And thankfully, I think we filled out the offering within like a couple days of sending out the offering memorandum, and ultimately ended up being significantly oversubscribed. We probably could have done a deal twice the size as what we did the first time around. And that just gave us a lot of confidence to start looking for the next one, especially when the first one started to go well. And you can kind of tell 6 months in that it's probably going to be a good outcome, assuming like nothing crazy happens. And so with that feeling and the confidence we had from the first raise, we were able to start going after other ones. And initially, it really was a lot of coworkers, friends and family and stuff like that. I don't think in the first deal there was any family. I think it was all former coworkers, former bosses and friends and stuff like that. And then we just stepped up that outreach even more on the second transaction. And we also had the benefit of the 1031 exchange from selling the first portfolio too, which took up a chunk of the equity in the second acquisition.
Okay.
And then after we closed the second acquisition and launched Sweet Bay as like an official brand and company, our fundraising efforts really picked up a lot, and our investor list started growing a lot more once we were actually focusing on it full time and putting all of our attention behind it. And so by the time our third acquisition came around, the 90 unit one, we had built out our investor list of friends and family, coworkers, bosses, etc., a lot more thoroughly. But then we also had started building relationships with some small institutions and funds of funds and stuff like that. And we're able to get two large investments relative to the size of a lot of what our friends and family were doing, but relatively small investments for like an institutional. But we're able to get them into our deal and kind of, again, going back to relationships, start building those out more, and which helped us round out the fundraising, but also kind of sets the foundation for doing more deals in the future with groups like that can write larger checks consistently, which is what you need, I think, to really scale and be, confident with being able to execute on a raise and close a transaction.
Yeah, for sure.
We also haven't had to co-GP with anyone or anything like that yet. There hasn't been any JV partnerships with the deals we've closed so far either.
And you've taken quite a leap by jumping out and starting Sweet Bay Capital. Tell me a little bit about that. There's a lot of folks that are listening that ultimately want to be making that transition at some point, but it's a scary one.
Yeah. Well, I mean, like I said, this was not something that happened overnight. Mac had, I think, bought his first rental cottage that we've been talking about in 2018 or 2019, and we didn't officially launch Sweet Bay until 2023. So that's a 4 or 5 year kind of runway for him.
Yeah.
And mine was a little bit shorter than that, but still multiple years. And I think what's made it easy, and, I think a lot of people want to get out of their full-time jobs as soon as possible, but it really is a luxury because you have that consistent paycheck that's coming in every week.
Mm-hmm.
And it makes it a lot less stressful to turn down deal after deal after deal when you still have, reliable source of income coming in. And so, we closed that investment in 2021, and we started looking for other ones shortly after that, but we passed on a ton of opportunities, and we were able to do that because we had our full-time jobs. And so when we saw the two properties in Roanoke that we ended up buying come to market, we had passed on so many before that we finally saw one that we had a lot of conviction in, and it made it just easier to kind of make that leap versus trying to jump in too quickly, or like quitting your job to focus on it full time. And then, if you're not getting that paycheck every week, you're under a lot of pressure to find the next acquisition, because, you need that to kind of sustain yourself. So I think taking it slow, it can be hard, and it takes a lot of patience and persistence, but there definitely are some benefits to kind of spending the time to get yourself educated and experienced with smaller, maybe personal investments and things like that, even if it's just a single family home or a duplex or a quad or anything like that, because it'll, one, build your experience and and also two, give you the confidence to execute on something bigger. And people will also, investors will want to see that too. They'll feel a lot more confident about your abilities as well. And then also, again, you just have the patience to wait for the right pitch, because if, you swing and miss on the first one, then you might not have the chance to get at the second one. So, that's kind of how we've approached it. And, we have been very focused on making sure that the downside on the transactions that we have done is limited, because especially early on, really with any transaction, but especially with the first few, you really just have no room for slip ups, or else it's going to be very hard to continue raising money for people when your first deal in your track record was a bad one or whatever.
Right. Yeah, exactly.
So again, just once you are ready to make the leap, I would encourage everyone to do it, and you really won't know until you try. But again, I would just caution people to not run too quickly into it until they spend a lot of time like getting themselves educated and maybe getting some experience and reviewing and passing on a lot of opportunities before you find the right one.
Yeah, I think that's great advice. And, we talked to so many folks on this show, and, a lot of course, the folks that have already taken that step, their advice is often, to go with somebody who's doing it full time. But I think what you said about being able to pass up many of the deals, there's something to be said about that.
Right. I mean, if you can find someone to kind of partner with in a way that is already doing it, then maybe that's a good way to kind of, do it with your training wheels on, so to speak. So I'm not saying that the way we approached it is the right way. The thing I just try to tell people is that a lot of people look at their W-2s as a burden. They want to, gain that like financial freedom and be their own boss and everything like that. But it is really nice to have the backup of a W-2 job too.
Sure.
Yeah. So.
Yeah, makes sense. So then, what is obviously the market also has changed a little bit since you've gotten in, but you've still been able to transact. You've still been able to find good opportunities. What do you see in the next 3 to 5 to 10 years with Sweet Bay Capital?
We're under contract on our next acquisition, actually in North Carolina, which is 60 units, which should close, knock on wood, in the next week or two. Just looking at my desk, and it's not wood, but I think we'll be okay at this point.
Yeah.
So, I mean, we have goals to grow. Obviously, I mean, going back to the whole W-2 thing, it was nice to have that support when transaction volume has fallen, 50% or more in the last year or two.
For sure.
So we've picked an interesting time to start, but I guess it's worked out for us, at least so far. We would like to acquire more properties this year. We would like to start consistently doing, 90, 100 plus unit deals, 150. Again, I think some of your other guests have spoken about how much easier it is to manage a property that can support full-time staff.
Right.
Kind of how, as we were talking about earlier too, we would go smaller if it was a really attractive opportunity or a way to get into a market that we really wanted. but I know our ambitions are to kind of keep growing that transaction size so that we're consistently doing 100, 150 unit deals and eventually get to 200 plus. But that's a long way off to think about right now. It's just making sure that we're executing the ones that we have in our portfolio well and just finding that next one or two, hopefully this year, and then going from there.
Yeah, makes sense. So where all are you looking? I know in your intro, we talked about Virginia and Carolinas. What is kind of the biggest focus from a geography standpoint of where you feel is in your buy box?
Yeah, that's it. Virginia and the Carolinas right now, basically Fredericksburg, Virginia, all the way south to the bottom of South Carolina. We look really in a lot of different markets in those states. Typically, we will look in smaller markets. I mean, Roanoke is a smaller market, but we'd even look in smaller markets than that. We just want to make sure that with a lot of the tertiary markets, that at least the population trends are stable to slightly growing. We do get a little nervous about looking at small markets that have had, declining population just because we don't know who the next buyer or what the environment is going to be in those places in 5 to 10 years when we actually go to sell these properties. We look in big markets like a Raleigh that's growing super fast. The challenges with that is that everything is just very competitive and very expensive. And then you also are competing with all the supply that's coming on in some of these fast growing cities. And so rent growth has been stagnant and market occupancy levels are 90-ish%. So it can be challenging to execute there or win deals there. And on the flip side, there's other markets like a Roanoke where it's less growthy and it doesn't have a lot of the like sexy demographic trends that like a Atlanta or a Charlotte or a Nashville has or something like that. But they are still very stable and the value you can get there is much better. And when you just look at like the per unit rent versus the per unit purchase price, can be much more favorable. And then you also look at things like market occupancy where there's very little new supply coming in. So you're talking about 97% occupancy, which, makes it much easier to manage and also kind of ensures that even though the market itself isn't growing that rapidly, there's actually consistent rent growth because the market is just so tight from a supply perspective. If you go look back and compare like the year-over-year rent growth for like a Roanoke versus a Raleigh, it's actually not that different. Obviously, a Raleigh has a much more like stable and dynamic and growing economy, but so there's kind of pros and cons of a lot of them. We've been able in Roanoke and next acquisitions in Winston-Salem, North Carolina, have been able to find opportunities where, as I said, have owners that hadn't been investing in the property or maximizing it as much, which gives us a chance to kind of come in and do that, which we found is harder to find in bigger cities like a Raleigh, where there's a lot more groups like us or just better, more sophisticated management companies and just kind of a higher bar in general, which means it's harder to find opportunities with a lot of upside that are also reasonably priced. It's just all a balance.
What about like with some of the value adds that you're doing? Are you working with any particular suppliers to be able to get things at a better price, or what? How are you working that angle of it?
So at first we've never actually used a GC, so we've never had to pay like a construction management fee or anything like that. We sourced subcontractors directly ourselves and would work with the property manager to make sure that they were scheduled and that they can get into units and that he was checking the work and stuff like that. That was kind of the first step. And for that, we were also going to like Sherwin-Williams for paint and flooring and stuff like that. And they would also do the installation. The next step, now that we have a bit more size, is to try to start purchasing some of the materials directly from vendors and trying to buy them more in bulk and storing them at the property. because we'll know we'll need them eventually, and get to the point where, we're not buying LVP from Sherwin-Williams. We're buying LVP from who they're buying it from, and we're having our own people come in and install it. And so can kind of cut out a middleman basically in the process and hopefully get better pricing and things like that. And now that, we are building scale in the market, we can start having more control over that. And I think we still have a long way to go before that becomes really efficient for us. But those are kind of the things we're focused on. It's just trying to, cut costs where we can and figure out ways where we can source things more effectively, and just build out our network of contractors and things like that we can rely on directly versus paying someone a markup to do it.
Yeah. What about the debt that you've put on these? About how much loan to value or loan to purchase price have you been doing?
So the one we're about to close is an assumption with Freddie. The 90 unit deal we closed in December was also an assumption with Fannie. And the one before that, the first two properties in Roanoke, was bank debt. But those have all been relatively low LTV. A lot of the times with the bank debt on the Roanoke transaction, because the property was so below market in terms of the rents it had, it was just hard to lever up because in-place NOI was so low. And we've kind of stayed away from floating rate debt and bridge debt and things like that. So we've been able to kind of lever the deals conservatively, but enough to make them work. And we'll probably, we'll explore, if we don't sell, refinancing some of these in a year or two, because at that point we think they would be very underlevered with where NOI ends up being once we execute our business plan.
Okay. And on your business plan, as far as rent growth assumptions, that kind of thing, what are some of the things that you're looking at or calculating into the numbers?
Well, so there is an underlying market rent growth assumption in the model, but where most of the rent growth comes from is taking a unit where someone had lived in for 5 years and then is not renewing their lease and is moving on to somewhere else, and taking that unit up to where we think market is after having renovated it with new appliances and maybe installing a dishwasher and revamping like the kitchen layout some and things like that to kind of update it to kind of a more modern standard. So that's where most of the rent growth comes from. We try not to just bank on market rent growth. We try to do it more of a mark to market underwriting to kind of drive our returns versus just waiting for the growth to come to us. Yeah. And yeah, obviously look at that. Just really dig into the rent comps a lot. And also the property management company too can have a big impact on that. If you have a really strong manager, then you can kind of unlock those rents maybe better than someone else can. And finally, if you do it the right way, if you cohort out your renewals and things like that so that your vacancy is never too high, and you do a good job of getting people to renew because you're investing in the property and they see that you're making improvements and you're making their life better, that they'll stay, then your vacancy should never drop too much. And then you can kind of be patient and wait for the higher rents versus going into a deal and kicking everyone out immediately and, having really low occupancy. Then you're under pressure to fill it a lot faster. And you can do that, but you'll have to do that by, getting to rents, like concessions and things like that, and not maybe getting to the current market rent is. So it's a balance, but yeah.
Anything that has been maybe a surprise or not necessarily just something that maybe you didn't realize coming in that you kind of have learned along the way that you want to share with the audience?
Just everything. You cannot underwrite to precisely what you think is going to happen, because there are things that will happen that you'll never be able to predict. And so you need to be prepared for the unexpected, and you need to have the cushion in your underwriting to handle that. And I think that's something that we haven't really had any backbreaking problems with any of our properties yet. There are, consistent issues with things like, you replacing the dishwasher, and the person that took out the dishwasher took the hookup. And so when the next dishwasher comes in, you'll have the hookup. And so you have to go just random, little problems with property management that happen that you just don't think about when you're in your Excel model or whatever. But just being aware that that stuff is going to happen. And if a property manager tells you that they can renovate a unit in 5 days and get it turned around, then don't make your underwriting hinge on them doing 100% of your units in 5 days.
Yeah.
Make sure that you have a little bit of buffer and just flexibility to deal with the unexpected is the biggest thing, I think. And then what ties into that is underwriting conservatively. And then also, I would just say just to not get too enamored with a deal. If you spend enough time on something and you just tweak enough numbers in your Excel model, and you and your buddy just keep talking about it, you'll find ways to tweak assumptions to make the numbers work.
Right.
And that's, I think, how you can end up in a scenario where you pay too much for something. And the best way to avoid that is just to have a really consistent pipeline where passing on a deal isn't that painful, because you've got, 3, 5, 6, 7, 8, 9, 10 other ones that you need to go look at. And so it goes back to what I was saying earlier about just waiting for the right pitch.
Yeah, for sure. Yeah, this has been really good. I appreciate it, Tucker. How can people find out more about you, about Sweet Bay Capital?
Sure. Yeah. I mean, the best place to look is either our website, sweetbay-capital.com, or just to look us up on LinkedIn. Again, my name's Tucker Thompson and my business partner is Mac Shelton. Those are probably the two easiest ways to find us.
Cool. All right. Well, I've got 2 more questions for you that I ask every guest. And one is just what advice you might give somebody who's just starting out in their investment journey.
Trying to think of something I haven't already said this podcast. Again, I mean, depending on where you are, there's the waiting for the right pitch, I think, is really important. I don't think you can ever underwrite too conservatively. And then actually the thing I would say that I forgot to mention earlier is that when you do your first syndication, you hit send on that first OM and you're sending it out to people that you know already. I mean, the people that you don't know is different, but a lot of the people that you do know already are going to trust you more than they look at the analysis or the numbers that you present to them. And so just be very, confident in what you're presenting them and stuff like that, and your ability to execute, because, they're a lot of them will be banking their decision on you personally, and less about all the different analysis and slides you put together and market data or wherever else you share with them. And so that's good in a way, because I think a lot of people might be hesitant about their ability to raise money from people. And I think a lot of people will just trust you. But on the flip side is you just have to be very, careful with that trust and make sure you don't cause it to go away.
Yeah. No, I think that's a great point, and it's especially for somebody that's newer in the business and just trying. I mean, you're trying to win them over with the numbers behind it, but when at the end of the day, they're looking at you, looking at your experience, and I think even investors that might not know you, they may know of you, they may have heard of you, they may have seen, kind of what you've been doing. There's obviously some number folks out there that just are very concentrated on the number of the, associated with the deal, but most people are betting on the jockey. So,
yeah, I mean, I on the first 2 transactions, I'm not sure how many people actually read every single slide or even like the operating agreement and stuff like that. It wasn't until we started getting bigger and bringing in more people that we actually started getting questions about assumptions and legal things like that. So, but that doesn't mean don't do it and don't do a good job on it, and because it is also your underwriting. But
for sure.
But yeah.
Yeah. And then I've just got one more question for you, Tucker. And that would just be a book recommendation, maybe something you've read recently that's been impactful. It doesn't have to be real estate related, but it certainly can be.
Yeah, good question. Trying to think. There's a couple good real estate books, but actually, just give me a second to think about this. I have my book list I've read recently.
While you're bringing that up,
Yeah.
As far as holding on the properties, you mentioned on one of the first deals that we talked about, you kind of had a 5-year projection, but you know now the numbers have improved as much as they have. You're looking at maybe doing a refinance, but are you looking at most of these as like a 5-year hold, or are you looking more long term than that? Or
we underwrite to a 3 to 5 year hold. I think we typically underwrite to 4 or 5 years, mostly 4 or 5. I mean, it's easy to make the IRRs look really good if you do like a 2 or 3 year hold or something like that. The first deal we actually underwrote for a 10-year hold, which was kind of silly in hindsight because we sold it in 15 months. But yeah, typically 4 or 5. In terms of the books, yeah. So I can come back to that now. How do you want to?
Yeah, sounds good. On the book recommendation.
Yeah, so a couple real estate books. One, The Birth of a Building isn't directly related to like multifamily real estate investing, but it just gives you a really high level, like conceptual overview of everything from like the ground up in real estate, which I thought was really helpful. And then there's a couple other ones like Best Ever Apartment Syndication book and some others that are just good high level intros into apartment syndication. I don't think they're like Bibles by any means, but if you're trying to listen to an audiobook and learn a little bit about it, those are, I think, good recommendations.
Yeah, that's great. I have not heard or had anybody recommend The Birth of a Building, so I'll have to check that one out myself. So appreciate it. Yeah, thank you so much, Tucker. I appreciate it, and I think we'll call it a show.
All right, thanks, Keith.
Yeah, thank you.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.